today's video, we're going to be taking a full in-depth look at how you can grow a small account in trading. So we're not just going to be covering the strategies, we're going to take a look at the most important parts of it that most traders won't show you. Risk management, sizing, entry and exit processes. You guys will have a full understanding of all of that by the end of this video. Now, most of you guys have seen in 2024, I grew two different small accounts. I took one account from $5,000 to $83,000 and another one from $10,000 to $118,000. So I had first-hand experience growing an account recently, and I'm going to show you guys the raw reality of everything that goes into it and how you can do it yourself. So before we get into everything, I want to take a look at the two accounts that we grew in 2024 using everything that I'm about to show you guys. So we had this first account, which we grew from $10,000 all the way to $118,000. And then we had our second account, which we took $5,000 into $83,000. And they're both pretty much the same setups, same strategies, everything you guys are about to learn right now. So over here, we have all of our payouts and withdrawals on the accounts. You guys can see first one right here, we paid out about $118,000. And on the second one, we paid out about $80,000. So everything on this account was done live in front of thousands of people. You guys can go back and check pretty much all of the trade history. You guys can see the live logins and live withdrawals on my Instagram. So it's all available for you guys to go ahead and check out and also verify for yourself. And also maybe learn a little bit more about the strategies I used in real time. But basically the reason I'm showing you guys this is because it's very simple to grow an account the same way you guys trade a regular account. There's not much else that really goes into it except for a little bit more proper risk management. So with that being said, let's go ahead and take a look at our first topic that we need to cover for small accounts. So we're starting off with the most important thing that we need to use for a small account, which is going to be risk management. So whenever a lot of you guys start trading, you guys are trying to hit big wins, trying to go for something crazy so you can get that small account off the ground, and that's not going to work. All right, you have to stick to a strict system regardless of whatever your size is. You need to make sure you guys are sizing 5 to 10% of your portfolio on each trade. So worst possible case scenario, let's say you have a $1,000 portfolio. Okay, you take a $100 position, some crazy news drops, you take a loss, whatever. You're moving on with a small loss. You're not blowing your account in just one trade and you're done, right? That is why we have to stick with 5 to 10% of the portfolio. We're not looking for some crazy 500% or 600% win. We're looking for small 20, 30% wins, and that's it. We're not interested in anything crazy. Now, leading into our second point, we never ever want to let a trade go more than 20 or 25% stop loss. This is very, very important. A lot of traders kind of marry a ticker and they don't let it hit stop loss and just let it go. They hold on to that trade like their life depends on it, and they end up blowing accounts because of that reason. So no matter what happens, if a trade hits 20 or 25% stop loss, close it. Don't even look twice into it. Close it, move on to the next one. Okay, never ever should a trade go past that stop loss level. So that's number two. These are probably the two most important ones that we really need to have for this entire concept. Now, number three, maximum 2 to 3 trades a day. You guys are starting to get into trades wherever I see 5, 6, 10, 20 trades even a day. That is what really messes you guys up. Okay, if you guys stick with 2 to 3 trades a day, you're gonna be totally fine. Okay, whenever you start getting into those 10, 20 trades, that's when things become a problem. The less trades you guys take, the more money you'll make. All right, is that very clear? So really very, very simple things right here. Nothing really too crazy. 5 to 10% of your portfolio on each trade, maximum 20% stop loss, and maximum 2 to 3 trades a day. You need to be very strict on this. You want to make a sticky note and tape it onto your laptop, you can do that, but it has to be followed every single day. All right? If you guys don't follow these three, pretty much nothing's going to work. So, risk management, most important thing right off the bat. We're going to take a look at some more things that go into a small account that you guys also need to take into account. So, trading strategies. This is the second most important thing after risk management, and it honestly is something that's more up to your personal preference. So there's thousands of trading strategies that really work out there, but in my opinion, and the one that I used for growing my accounts, was these three right over here. In today's video, I'm going to mainly focus on the break of structure fair value gap, which is my favorite setup, and then we'll take a look at liquidity sweep and fair value gap maybe in a separate video, or if you guys want to go back and check out videos on those concepts, I have multiple videos covering all of them. So just figure out what you like. There's thousands of setups, like I said, that work. You just got to figure out one that works for you personally and stick with that setup only. All right, you don't have to switch around setups every single day if you take a loss or anything like that. Find one, back test it. If it works, stick with it forever. Don't have to keep switching every 2 seconds. So in my opinion, break of structure fair value gap is going to be the best, and that's what we'll focus on in this video again, and show you guys some examples for trades that I took using that concept. So trading strategy, risk management, those are two very important things that we need to have as the core of this concept, all right, of growing our small account. So it's like building a building, right? If you don't have a foundation for that building, it's going to fall apart in a second. So risk management and your trading strategy are going to be the foundations for these setups. And if you don't have that, consider yourself done. Okay, it's not going to work. So now let's take a look at the entry and exit processes for these trades. All right. Now, a lot of traders do something that we know as scaling, which is taking partial positions out. Meaning, let's say you have 100 contracts, you take 25 contracts out, another 25, another 25, another 25, and that messes up your profits. Okay, this is something a lot of traders don't talk about, but it's really, really important. And the reason is, let's say you take a trade and, $1,000 worth of a position, and you scale out slowly for a 25% win. You're only going to profit about $100, okay, $100 to $150. However, whenever a stop loss hits, you're taking a full position loss on that trade, all right? Which means you're taking wins of about $150 and you're taking losses of about $250, okay? That's obviously not a good risk to reward. You want to stay away from that. So what I like to do personally is I like to raise my stop loss instead of doing a scale or partial exit whenever I'm growing a small account. I'll show you guys some more examples of what that is in a second, and it'll be a little bit more clear. So avoid scaling, try to keep a full position, one entry, one exit. That helps grow a small account much more. So number 2, we talked about this a little bit in risk management, but small base hits are your best friend, okay? We're not chasing anything big. I don't care about 500 or 600% wins. I'm focused on little 25, 35% wins, and that's it. I'm not interested in anything crazy. This is where a lot of new small account traders go wrong, because you guys try and chase something big just to get that account going. And that's going to totally destroy you. It has to be small, it has to be consistent, and your account is going to snowball over time, all right? It's going to keep continuously compounding until you get bigger and bigger and bigger. And when you get a bigger account, that's when you guys can start finally taking into account, hey, maybe now I can take a little bit bigger sizing and things like that. All right. But for that initial phase of starting off, nothing big, small base hits. That's all we care about. Now, one more thing for our exit process. This is where people get confused. Everybody can enter a trade, but where do we exit the trade? Right? That's something that a lot of people don't understand. So whenever I'm exiting a trade, it goes one of two ways. Either I target the next key level, or I'm raising my stop loss until it eventually hits. And I'll show you guys an example of that in a second, like I said. So again, for our entry and exit process, avoid scaling, full one entry, full one exit. All right, no partials, no nothing like that. Number 2, small consistent wins. Don't focus on anything big. It's going to destroy your account if you do. And number 3, we want to target the next key level, or we want to go with the fair value gap and raising your stop loss method that I'm going to show you guys. All right. So that's pretty much the core concepts that we need for this small account process. If we have these in place, everything is going to be really simple, but you guys really need to follow this. Otherwise it's not going to work. Write it down, stick it on your laptop, do whatever it is, but make sure you're following all of this. So now we're going to go ahead and take a look at some live chart examples of trades that I've taken using these setups and this exact system, and show you guys kind of how to execute on it in the live markets. So we're going to go ahead and take a look at a few examples of the break of structure fair value gap, but I really want to focus on the risk management and everything else that goes into the trade rather than the actual setup itself. All right, so we'll take a full in-depth look at everything that goes into this trade. All right. So the first thing we look for with a break of structure fair value gap is obviously the first pre-market high and the pre-market low. So in this case, you can obviously see the highest point that price hit was all the way up here, and the lowest point that price hit is all the way down here. So all I want to do right now is I want to wait for price to break either one of those levels and see how price acts to determine what direction we're going to play. So in this case, let's take a look at what happens on this low. So right here, we get a very strong break with a really clean candle. So now we're interested in setups to the downside. All right, so now that we got that clean break, the next thing I'm looking for is a fair value gap so I can take an entry on this trade. So this right here is a perfect fair value gap with a perfect reaction. All right, so I want to give you guys an insight into how we find our levels and how we manage our risk on this trade. All right, so we have everything that we need. We have the setup there, but the proper way to manage risk is going to look like this. So to find my exit on this trade, I'm going to go over to the 1 hour time frame. All right. And I'm going to look for the next level that we have coming up in this range right here. So if we go back a little bit, we'll see that the next level that price has in this case is all the way down here at 119.50. Okay. So all we do for that is we literally just take a look at where's the next level that price has room down to. And that's where we set our targets and stop losses and everything. Okay. So in this case, the next significant low that we have in the market on the hourly time frame is going to be at 119.50. All right. So right now you have your entry on this candle. We have our target, and now we need to figure out what our stop loss is going to be. All right. And let's take a look on this entry. How would we place our stop loss? So we need to place the stop loss right above the high of the middle candle of the fair value gap. So if you take a look, not the first one, not the third one, but the middle candle, we want to place it above the high of that candle. All right. So if price does not break the high of this middle candle, we're in that trade, we're fine, we can play it with no problem. All right. If it does break, we close it, we move on to the next trade, we don't worry about anything. You're not holding anything past that level. All right. And I'll show you guys why I'm choosing this exact example of a trade we took so you guys can get a better understanding of risk management. All right. So in this scenario, all right, target is right here, stop loss is right here. Whatever is going on in between all of this means nothing to us. As long as price doesn't break this level up here and it doesn't hit this level, we're still in that trade. Okay. And that's the way to really manage your risk. All right. A lot of you guys start panicking when you see a little bit of green or you see a little bit of red and you guys just exit the trade, take a loss or take a small win, and that's it. You really need to stay in the trade to both directions. It's very, very rare that I'll say it's okay to exit a trade prematurely. It's only if you see something really crazy that, I don't know, some crazy news dropped or something like that. That's the only times I say it's okay to exit prematurely. Okay? Other than that, you have a stop loss set, you have a target set, let it play out. Okay? Don't do anything until either one of these hits. So let's go ahead and see what happens on this trade. So if you guys take a look right here, the stop loss comes really close to hitting, all right? But we don't end up hitting that stop loss. Price comes very close to it and it gets a move down to that low right here, okay? So why did I choose this exact example? Because a lot of people see price getting a little close to their stop loss or a little bit into red, panic, sell, and then price reverses in their favor later, okay? As long as it does not take out the high of this middle candle and it has not taken out this target, you are in that trade. Is that clear for everybody? All right. As long as we haven't taken out one of these levels, you are in. Anything in between is absolutely nothing. And it's really important, especially when you're trading a small account, to take these things into account. Okay, because we don't have too much room for error there. All right. Now, if we are looking to play runners, or not runners, if we're looking to play a trailing stop loss, I would say. Okay, the best way to go about it is going to be the first fair value gap that breaks, we're going to exit that trade. Okay. So instead of scaling out a position, what I like to do is I just like to keep raising my stop loss to the first fair value gap that breaks. So let's say we keep going like this, okay? We keep marking out all these fair value gaps. There's a bunch right here on the chart, okay? So the first one that breaks is gonna be where we exit this trade, all right? So if we take a look right here, this would be where you would close it, okay? If your target was all the way down here, you would close it at the first fair value gap that hits that level, all right? In this case, we don't have to worry about that because we already got the target, but let's say if your target was really far away. To kind of mitigate that risk from not scaling out, we do this instead, if that's clear. All right. I'll show you guys a few more examples so you understand what I'm saying, but just to give you an idea, if your target's really far away, we're still not scaling out, but we're doing this to mitigate the risk. Okay. Just raising it until one of the fair value gap breaks. All right. So that's example number one. Main focus of this one is the risk management and how we're not closing a trade regardless if it hasn't hit the stop loss or the target. Nothing else matters. It's only if it hits one of these two levels. All right, that's number one that we really wanted to focus on. So let's go ahead and take a look at our second example of another proper risk managed trade. So right here we have Tesla, and this time we're using different levels for the break of structure fair value gap. All right, this time we're going to use the high of day and also the low of day. And the reason I want to show you guys this is because you can have either one of those be a case. It can be a pre-market high level. It can also be a high of day level. Okay, it can be high of day, low of day. That's totally fine. It just depends on where we have a setup. All right, guys. So in this case, we have a high of day and a low of day. And price comes and gets a very, very strong break of that low of day level. All right. So we are now looking for setups to the downside. All right. So step number one is complete. Second step is to look for a fair value gap. So let's go ahead and see if that pops up. So right over here, you guys can see we have two fair value gaps. And this is a really good question that I get asked a lot of the time by people is how do we know which setup to play? There's three different fair value gaps right here. Okay. And the question to that and the answer is that we are going to play the one that has the most recent pullback. Okay, so the first fair value gap that tests and gets followed through is the one we're going to take a trade on. All right, in this case, you have 1 fair value gap, 2 fair value gap, and 3. The third one is the first one that tests. That is the one I like to play. Okay, guys, I'm not waiting for this third one up here. I'm waiting for this first one that really gets a pullback. That's the one I'm going to play. Okay, you can have 4 or 5 fair value gaps. I like to play the last one. Alrighty, so right now we have our setup complete. Okay, we have our break of structure, we have our fair value gap, and everything is complete. So now we have to focus in on our risk management. So, reminder, let's say you have a $5,000 portfolio. Okay, just to put into perspective. In this case, I see the setup, it looks great, and how would I enter this trade? Okay, first thing that we have to understand is that it's only 10% of the portfolio. So I'm entering with only $500 on this trade. That's number one. Okay, my maximum stop loss is going to be 20%. So worst possible case, I'm risking a $100 loss. Alrighty, so worst case, 20% stop loss. Let me set that there, minus $100. All right, now for my profit target, we want to aim for somewhere around 25 to 35%. In this case, we'll meet in the middle and say maybe 30%. All right, so in that case, we'll have about $150 profit. Okay, around there somewhere. So we're risking about $100 for $150 profit. Okay, not the craziest risk reward. It could be a little bit better, maybe have your stop loss be a little bit tighter, but this is taking into account the worst possible case for stop loss and kind of in the middle for target. Alrighty, and just with this, you're going to be profitable. You'll be fine. Okay, so $500 per position, risk of 20%, target of 30%. Alrighty, guys. Now, let's go ahead and take a look at a risk management that we used on Tesla and how we did it really well. Alright, so you can take your entry on this candle right here with a stop loss right above the high of the middle candle. Alright, and now we'll go back to the 1 hour time frame one more time and take a look at what our next level is going to be on Tesla. So as of that given moment, we have, let's see, we have a low all the way down here that we can look to target. So that could be our next level for price to go to. Alrighty. So in this case, you have a very, very nice stop loss set. Okay, and you have your target all the way down here. So we'll take a look step by step how we trade this and have proper risk management all the way down without scaling out of our position. All right, so let's take a look candle by candle and see what happens. All right, so right now we have our first fair value gap right over here. Okay, if price breaks this fair value gap, I'll close the position. If not, we are staying in that position. Alright, so as you can see right here, price did not end up breaking this fair value gap. So now what we do is we raise our stop loss to the next fair value gap that shows up. So in this case, my new stop loss is all the way down here. Alright, if price breaks this fair value gap, I will close the trade. Okay, if it hits this target first, then I'll close it down here. Alright, so let's take a look at what happens. So on this trade, we are closing our position right over here. Okay, because price broke the first fair value gap before we got to our target. Is that clear? So this is kind of how I mitigate risk. And if we take a look at that, that's a really solid risk reward of about 2R. Okay, so that is kind of how I'm mitigating risk. Instead of scaling out, I'm doing this instead to make things a little bit easier for myself. Alrighty, guys, I'm not really doing anything too fancy, nothing really complicated there. I just keep raising until the next fair value gap breaks, and that's when I close it if it hasn't hit my target yet. Alrighty, so in this scenario, you have proper risk management across the board with sizing, with your stop loss and take profit, with your entry. Everything is perfect right here. Okay, so you have a perfect trade. Okay, executions, perfect. So any trade that you take is going to look something like this along the lines of these same Tesla trades and the video one I just showed you guys. All right, whenever you start deviating away from this, maybe oversizing, maybe over trading, or not setting up a correct risk to reward ratio, that is when we end up in problems. Okay, if you follow trade setups that look something along these lines, you guys are gonna be perfectly fine and you can grow a small account with ease. Now let's take a look at one last example to give you guys a better idea, and that should be all, and you guys should have a really good understanding of how this works. So here we have another one on QQQ, and if you take a look right here, you have a pre-market low and a pre-market high. So price breaks the pre-market high, we get a really nice fair value gap. So how do we enter this trade and execute on it properly? All right, so let's use that example of $5,000 one more time. Alrighty, $5,000 position. We need to take into account that we want to use only $500 on this trade. Okay, 10% of the portfolio. If you have $10,000 account, $1,000 per position. $100,000 account, $10,000 per position. All right, 10% of whatever your account is, that is going to be per position. Alrighty, same thing that we used on Tesla again. Same stop loss, same take profit around there is kind of what we're aiming for. Or you want to go with this method that I showed you. That part is up to you guys. Do you want to base on percentage, or do you want to go ahead and base on technicals? Okay, this is a little bit more advanced. It's up to you guys for your personal preference. I like to personally go with the fair value gap method rather than percentage, and it works out better for me in my opinion. All right, so let's go ahead and take a look at this trade on QQQ. Alrighty, right over here we have another break of structure and another fair value gap. You have a stop loss right under the low of the middle candle. All right, and you have your target at the next significant high, which in this case is going to be right up here, right at this high. All right, so what I'm going to do on QQQ is the exact same thing I just did on Tesla. All right, I'm going to have my target at this high, I'm going to have my stop loss at this low, and I'll close if any of the fair value gaps end up rejecting before that. Okay, if not, I'm still in the position riding until we get to the target. So let's go ahead and take a look at this trade and see exactly how we manage it in real time. So far we had a really strong move on QQQ, and now we just had a fair value gap that popped up right over here. Okay, so if price can break this fair value gap right up here, then I'll close the trade. If not, I'm still holding this trade for a move up to this target right here. All right, so let's take a look at what happens. Perfect. So in this situation, we got a really nice move directly from the fair value gap all the way to the target. So we didn't end up breaking any fair value gaps along the way, and we just got a direct move up to that high. Alrighty, so this is perfect. This is absolutely what we want to see, and this is just as A+ of a setup as you can get. All right, but I'm mitigating that risk along the way just in case it doesn't get to the target. Then we're still securing profits without having any extra unnecessary risk. Alrighty guys, so 3 perfect examples right there. You have QQQ for a move up to the target with no fair value gap mitigation. You have Tesla with another perfect one, but this time we had a fair value gap mitigation. And Nvidia right here, which also ended up being a really good trade if you manage it very properly. Alrighty, so overall, really clean. If you guys follow the system every single day, not missing a single day of messing things up or whatever like that, this is a very mechanical model, so pretty much anybody can implement it. It doesn't have anything really crazy or intuitive. Very simple, very textbook, as long as you guys follow it very consistently. So hopefully you guys enjoyed this video and you're able to implement the exact systems that I use into your own trades. Also, if you guys ever need extra one-on-one help from me personally and a fully customized trading system for your account, make sure to apply for the private mentorship in the link in the description below, and we'll hop on a call to make sure you're a good fit for the mentorship. If things are good, my team and I will work together with you until we get you a completely profitable system and have you take your own trades. So again, I hope you guys enjoyed this video, and I'll see you guys back next week for another video.